Welcome to another performance-based insurance webinar, evaluating performance-based insurance for your next renewal with speaker Bob Phelan. Before we begin, a little bit about the technology. Your lines are muted. You can ask questions at any time through your question box. Now about our speaker. Bob Phelan is the author of 2 books, most recently, The Cost of Ignorance, What You Don't Know About Performance-Based Insurance Can Save Your Company Millions. He's a 37-year insurance veteran, CEO of the Litchfield Insurance Group, and lectures nationally on insurance topics just like the one today. He has an associate in risk management, and with that, Bob, the floor is yours.
Questions here will be answered today. What is performance-based insurance? And it's in its simplest form, it's exactly what it says. The cost of your insurance is based on your performance. Who uses it? Performance-based insurance is used for everybody from the Fortune 500 to down to companies that spend as little as $100,000 to $150,000 a year. They use it because it saves money. You know, that's the bottom line on it. It's what most companies are interested in today is alternative ways to save money. There's other benefits, but that's the biggie. Is it right for you? We're going to know that very quickly because it's not right for everybody. And I can show you, if it is right for you, how you can use it to compare it to the next renewal that you have. Companies, who are the companies that don't use performance-based insurance? Well, you're probably one of them. You use what's called conventional insurance, or more commonly guaranteed cost insurance. And the reason it's called guaranteed cost is your agent or broker comes at the beginning of your insurance year and says the insurance for the next 12 months is going to cost $225,000. If you have one claim for $2,000 during that policy year, or if you have 10 claims worth $1 million, you still pay $225,000. And what the companies that want performance-based insurance are the ones that have superior results and always could pay a premium that is less than that guaranteed cost. If you've been buying insurance for any period of time, you know that there are unexpected premium swings where your broker comes out and says your experience mod is up, or you had too many claims in an automobile last year, and all of a sudden you're shocked with a 10, 20, 30% rate increase that you didn't anticipate, didn't budget for. And every company would like to eliminate that. This next bullet point, to get into a little more detail, is what happens to all those excess dollars in guaranteed costs? If you pay $225,000 and only have $25,000 in claims, what happens to the other $200,000? It's not returned to you, so it goes someplace. And as we say in this bullet point, the majority of it goes to subsidize the unsafe companies whose $220,000 wasn't enough to cover their claims. They had $300,000, $400,000, $500,000, $1 million worth of claims with only $220,000. The insurance company had to go someplace, and they went right into your pocket to subsidize those unsafe companies. Most people with guaranteed cost conventional insurance go out to bid with relative frequency. Sometimes they're content and they're happy and they don't. But most go out to bid with regularity, and going out to bid is expensive, time-consuming, and frustrating, and another problem we'd love to eliminate. So why are companies moving to performance-based insurance? As I said earlier, it's primarily that fourth bullet point. You get to keep profits, and the last bullet point is you get 100% reward for favorable claims. Now, if you have you devote a lot of time to safety and you have very low claims, all that excess money is going to your unsafe competitors and the insurance company. It's not being returned to you. And the reason companies go to performance-based insurance is they want to keep those profits that they earn. It's plain and simple. If you're going to work really hard at safety, you're going to work really hard at minimizing and managing the claims that you have, why shouldn't you be the one that's rewarded for it? So what is this performance-based insurance? It comes in many different forms, and we'll see that on another slide. But it was a concept created by the very largest companies that we call the Fortune 500. If you look at these bullet points, we just give some data on the Fortune 500 and what they amount to, and some of the named companies and what they're worth. Well, they have professional insurance buyers at these companies, and they're called risk managers. And they have entire departments dedicated to managing the cost of insurance because they pay a lot of money. So what do they know that you don't know? Well, what they know is performance-based insurance is the only way to fly, because they've got a whole department of people that are dedicated to minimizing their claims. And if they're going to minimize their claims or prevent their claims, they want to get the money back. And they do it through performance-based insurance. The name that you may have heard before that is one of the biggest categories of performance-based insurance, and it's called a captive insurance company. And that's what each of these companies have, is they actually have their own insurance company. They don't transfer their risk to Travelers or CNA or the Hartford or Liberty Mutual. They form their own insurance company, and there's mechanisms built into the tax laws that allow that. And they build it in such a way that they pay themselves, and when they have good years, they get that money back. What our expertise is at my company, and what in the model we're suggesting here, is something called a group captive insurance company. And what that means is a group of middle market companies collectively own their own insurance companies, and they work exactly the same as what the Fortune 500 uses. Because the middle market company isn't big enough to create their own insurance company, there are consultants and brokers who pool them together in these mini insurance companies, which range in size from 30 or 40 members to hundreds of members. But the mechanism is exactly the same. So when you join one of these programs, as I'm about to illustrate to you here, you are buying insurance in the exact same way as the Fortune 500. Here's the way it works now. Traditional insurance, or what I said, guaranteed cost insurance, if you look at the pie chart on the left, it costs about 30 cents on the dollar to run an insurance company. Just like you've got overhead and administrative expense to run your company, the insurance company has the same thing. And across all lines of coverage, it amounts to about 30%. The other 70% is allocated to pay claims. If you don't have claims, or you have a minimal amount of claims, all that money goes to subsidize others. So if you take that blue and you say, okay, 20%, I've got 20% in claims. Well, the other 50% goes to subsidize others. If you look at the pie chart on the right, the way this gets flipped around in performance-based insurance, 30% overhead, once again, 70% is the potential return. In an ideal situation, no claims, you get the entire 70% back. But in a more realistic scenario, on an average year, let's say it's 30%. That means the other 40% is available to you in the form of a dividend to reduce the amount of premium that you pay. So there's a real big difference here, where that 70%, instead of being used to subsidize others, that 70% is totally available to pay your claims. And if you don't have claims or have a minimum amount of claims, all of the rest of that blue area is available for a potential dividend. So what are the types of performance-based insurance? There are lots of them, and I'm not going to get into all of them today because many of them are only available to larger companies. So down in the lower left, you'll see what I just described, a group captive in the bold print there. And once again, that is when a group of middle market companies all get together, form their own insurance company, have their own board of directors, they own this thing, they run this thing, and that 70% is available to each member based on their own experience in the form of a dividend. What's nice about this too, a group captive, is you're used to your broker coming out and saying that the last 3 years of experience haven't been good, and you get a rate increase, or they have been good, and maybe you get a rate decrease. But those rates are dependent on the market conditions at the time. And those can vary from increases of 10% a year to increases of 30 or 40, 50% a year. When you're in a group captive, you aren't subject to market rates. Your rates are totally based on your own level of experience. So once again, you get to control your destiny. That if you have 5 years of good experience, you're going to get low rates when you renew If you have 5 years of bad experience, you're not necessarily going to get low rates, but in that 5th year, or 6th year, I'm sorry, you could have a great year. You could finally solve the problem, finally dedicate a lot of attention to safety, and you could still get that 70% dividend in the 6th year. That never happens with conventional insurance. If you have 5 bad years, it probably takes you 5 bad years to work your way out of it, and you can spend a lot of money in the process. Here's a direct comparison, and what I just said, premium determined by market rates versus premium determined by your own. Subsidized, which I think is the most horrible part of conventional insurance, versus pay by performance. If you do well, you pay less. When you're in a fully insured program, you're with a big company managed by the board of directors, they're going to make decisions that are favorable to them. When you're in your own insurance company, you're going to make decisions that are favorable to you. In fully insured, you can't control your own destiny. As I said, these market dislocations come at random times when you least expect it, and you have full control of your insurance destiny in a performance-based program. You earn the financial rewards, and you really never go out to bid again. We've had companies in these programs for 15 or 20 years, and they've never had to go out to bid in that entire period of time. Once you've changed to this, and once you start to benefit from this, you never want to go back to the old-fashioned way. I've shown you that there's 30% cost to operate the insurance company and 70% available to pay claims. And I call that the 70-30 insurance principle. Everybody can't leverage this. And these are key points here on this slide. We say that a company has to own their risk. What does that mean? It means they understand their risk and do everything they can to control that risk. The easiest word to think of in capturing that philosophy is safety. If your premium is going to be based on your own individual performance, well, you want to know that you've controlled your own individual performance to the greatest extent possible. If you haven't done that, then this program is not for you because it's going to be too risky. If you don't have a safe work environment, unpredictable, well, then your insurance costs are going to be unpredictable, and you'd be better in guaranteed cost because you're going to be one of those companies that gets subsidized. And if you're on the other side of the equation where you don't control claims, you want to be subsidized. You want to just pay the $220 even though your claims are $300 or $400. Sooner or later that's going to catch up with you. Sooner or later any company that ignores safety is going to be in trouble. They're going to be non-renewed by their insurance carrier. They're going to be debited and pay a lot of excess premium charges. But you can be marginally safe and just depend on getting subsidized by others. So this, if you do not have this leg of the pyramid covered, safety, this program is not for you. We find companies and talk to them, and they're not safe companies yet, but they want to be. And we say they're not quite ready for PBI, or we say they're not PBI eligible, but we work with them because they have a desire. Some companies don't have the resources or the desire to become really safe companies. They're just willing to deal with the status quo. I don't mean to beat this up, but it's a huge element of performance-based insurance, and it's absolutely, positively necessary that safety is a big deal in your company. The second leg of this is injury management. Even the safest companies have some claims. And it becomes, how big are those claims? Who's managing those claims? How are they managing those claims? All claims aren't managed equally. Whether you're interested in performance-based insurance or not, this is something that you can learn from this, is you should understand the injury management process of your broker and insurance company. A $10,000 claim with one company could end up being a $100,000 claim with another. If the claim management function is inattentive, if they don't care about the injured employee, and if that injured employee goes to a lawyer and sues you, that's how a claim can go quickly from $10,000 to $100,000. And if you're an experienced insurance buyer, you know that's something that's going to cost you money. either in your experience mod for workers' comp or your overall premium if you happen to be automobile. But injury management is a critical component. And when you buy insurance, you should compare the injury management functions and capabilities of the brokers and insurance carriers that are proposing to you. So if you have those two pieces in place, safety and injury management, you've controlled your losses, you've controlled your claims, you've controlled the amount of injuries that your company has. And that's when you're ready to entertain a performance-based insurance solution. That's when you can benefit from this. And if you're not in that position already, it's something that you can work toward and enter a performance-based insurance solution when you're ready. I think I've answered this question, why middle market companies switch. The biggest reason they switch is cost. The second biggest reason is probably to control their own destiny, not be subject to market rates, not be subject to unexpected increases in premium. The companies that get it, and the companies that own their risk, and the companies that succeed with performance-based insurance, on average, they save 25 to 30%, 35% a year. There are going to be some years that they exceed that savings, and some years that they have an unexpected claim where they don't have those savings. When you buy insurance, it's really critical that you look at it over the long run and not year to year. If you look at it year to year, you're never going to really save the money that you think you're saving. And a lot of that has to do with safety and injury management. You're going to buy from an insurance company that is cheap, and there's reasons insurance companies are cheap. They don't staff the safety function. They don't staff the injury management function. And you might think you're saving money, but as your experience deteriorates, all of a sudden you start paying more and more money, and some companies get into so much trouble that no one wants them. And then they really, really pay a surcharge. That last bullet point, we have seen some companies, really good safety programs in an individual year, save 50% or more. I've rarely seen companies that sustain that over a long period of time. That's why when I counsel companies, I tell them to look at this 25 to 35% savings and base their decision on those figures. I'm going to finish with some case studies. 2 years ago, we took on a large nursing home chain. And their company background is that they had, even though they were large, they were buying guaranteed cost conventional insurance. They went out to bid on every policy every year. They had 25 homes. They had 25 policies. For those of you who are current insurance buyers, you can imagine what it's like. Imagine going out to bid 25 times a year. Looked a little crazy when we came in. And we were excited about the opportunity because we looked at it, evaluated it in great detail, and suggested that they should form their own captive insurance company. They were big enough to form their own, spending several $1 million a year in premium. We went in and did that, and even though they weren't safe at the time, it still saved them over $1 million a year. We did a lot of work on injury management, and that's where those savings came from. And the second phase was to enhance their safety culture, to go into each individual home and teach the nurses a better way to live with patients. And it's been in place about 2.5 years, and so far they've reduced, it says 30% return on investment. What I actually mean there is a 30% reduction in premium. They started out saving $1 million a year. I think they're probably going to save about $3 million a year this year with a performance-based program. So they're pretty happy they made the switch. This is a regional contractor that's been in a performance-based program for a long time. And they didn't really own their risk. They were in a hazardous business, and they just felt that there was a certain level of claims that they were always going to have. And I convinced them that wasn't the case. I convinced them if they really dedicated themselves to improving their safety culture, it would make a difference, really beef up injury management, and redesign the performance-based insurance program. And in the last 4 years, they've saved $2 million, 50% return on what they spent on insurance. So this really works, but as I emphasized a few slides back, safety and injury management are critical components to get that superior performance. This is a company that's been in a group captive, which is the concept that we're talking about today as a form of performance-based insurance. This is a company that spends a couple $100,000 a year. They joined a group captive many years ago. They beefed up, like the last one, their injury management and put an intense focus on safety. And now they're paying they're getting a return on about 35%. If you look across these three case studies, in addition to what they get back in the form of dividends, they're also maintaining their annual year-to-year insurance premiums at pretty much a flat rate. And for those of you who are experienced insurance buyers, you know that that doesn't happen, particularly over the last 5 or 6 years. Since the economy was upended back in 2008, there have been a lot of rate increases, at least in the markets that we serve, and particularly with workers' comp. And workers' comp is the biggest component of a performance-based insurance program. It's where all the money is. And it's where you can control things, because that's where you can really make an impact on safety. So this is what it boils down to. You know, how can you figure this out? That first bullet point is your business spend $150,000 or more on insurance. There's a little qualification to that. The lines of coverage that go into these performance-based programs are workers' compensation, general liability, and automobile. So those are the three lines that have to add up to $150,000. Some of you may pay that much, but it includes property and umbrella, maybe marine and shipping and computer liability and other things. But it's just those three lines that have to add up to $150,000. If you're 135 or 40, we might be able to get you over the threshold. But workers' comp, general liability, and auto are $150,000. If you're at that number or higher, we could have a conference call, dig into this in a little more detail, and find out if you truly qualify based on what you have in place with safety and injury management. So that concludes the seminar today. I hope you've learned a lot. My 37 years worth of wisdom will pay off for you in your insurance buying in the future.
Thank you very much, Bob. We thank all of the people who attended today. If you want additional information, please reach out to Bob Phelan. His phone number is below, 860-761-7201. And I think we have a contact information slide on the next slide, Bob. You can request a copy of the PowerPoint slides, and you're welcome to email Bob or just respond to the email invitation that you were sent. With that, this web seminar is now